On this episode of Pennies Going in Raw, me and Hugh discuss this week in the market, volume, swings of the week, some Q&A, a scenario, and Hugh's DD on a special stock and how he got it all.
Hey, yo, check 1, 2. This is Flavor Flav in the building for the Atlas crew.
Atlas Trading, what the fuck is up?
There are traders, there are prodigies, and then there's legends.
We're up 4%, baby.
No way.
4 fucking percent.
Buy the fucking dip.
Hey, who told me to buy IDEX?
Like, dude, what the fuck? Like, someone just made, like, a lot more money than me on my trade.
You find out life's this game of pennies.
Did you check the portfolio?
Pennies.
The margin for error is so small.
I bet Warren Buffett never did that.
And they out there making money right now off of penny stocks.
Them two guys is putting in work to make y'all rich.
The pennies we need are everywhere around us.
It's time to think big.
Pennies Going in Raw.
Featuring Dan, Deity of Dips,
and Hugh Henne.
Produced by Vinny Strokes, baby.
Today is Monday, July 20th, and I just found out someone is messing with my friend Stan. Man, some Twitter drama going on here.
We don't like it. We do not like it. Stanimal is our boy.
We do not like drama here in the Penny Stock Podcast because it is all happiness and rainbows here. We're just out here making money off of penny stocks. Word to Timmy Sykes. You know what it is, but hey man, it seems like the market doesn't just go up. Monday and Tuesday were a little weird.
Yeah, Monday and Tuesday were real rough. The only money that I made was in options, Amazon options.
Yeah, the Cali shut down on Monday, and Tuesday China stocks were just annihilated, man.
Yeah.
That was pretty brutal, but it was business as usual after that, man. It was a big gut check for me on Monday and Tuesday that honestly I am happy to have escaped. But on the other hand, your week, not so bad.
No. This week was a much needed week for the portfolio. I think every single one of my swings went up around 15 to 20%. I think the only one that was lagging was RGLS, and it ended the week at 13%. So this was a much needed week for the portfolio. Haven't sold anything. My swings are still swinging. We're up over 100% on Trib. BMRA, I think I'm up 30%. You know, it was a much needed week. Thursday and Friday were two of the best days in a while. It was nice.
Yeah, you had some big percentage games, man, but it was all on swings, huh? That's what you rolled with. That's what paid off this week, huh?
Yeah, Thursday and Friday Monday and Tuesday, like I said,
your bread and butter, like you said last week.
Yeah. It's so funny that we were talking about it in the last podcast that Amazon is my bread and butter options place because that's really what kept my portfolio up Monday and Tuesday. And then Wednesday I was around flat. Thursday and Friday were just fire, absolute fire. The only money that I made was from the swings. I didn't even sell a share of anything, so hopefully it continues next week.
Yeah, man. I think that's actually a really good transition to get us into just our swings of the week. What are you still swinging? Do you have any new ones? I mean, I know I'm really liking SPAC, SPAQ, and also ONTX.
Yeah, ONTX is really fire. I think I saw Bog and Zach on it. That is a really nice swing. I think I saw some pretty hefty price targets of like 250, 3. I saw a price target of 5, and honestly, it looks like that's where it could be headed. I like ONTX. SPAC, I'm swinging. OTLK, I'm swinging. RGLS, and of course BMRA and Trib. The BMRA and Trib, I mean, you know, they've really been pulling away. I haven't sold a share of anything.
That's crazy. That's actually what I was going to ask. You haven't sold a single share of those.
No.
What if the market tanks tomorrow? Like, what if that all happens? You're not worried about any of that?
Until we get a PR saying that. Until we get a PR from the FDA, I won't sell a share. It's dumb. That's what I'm waiting for. And that's what I'm going to do. Why would I sell when the main event hasn't happened? It's like leaving the MMA tournament early before the 11 p.m. kickoff.
Dude, absolutely. You love sports. How do you accumulate these swings, man? Like, that was a question we had. We just figured we'd put it in here. How are you accumulating them over time? Just buying on dips, reading the volume?
Yeah, just buying on dips. I think the biggest thing to do is that I take about a 40% of the position that I ultimately would like to have as a starter, because I am always early. I'm always early, so I like to take a good chunk. And then I save a huge bullet for like offerings or unforeseen, filings. And that's like KTOV was a perfect example when we were swinging that. It was at I think 44 cents or something, and there was an offering that came out, and it went all the way to 32 cents. I think I tripled my position at like 32 cents. It was too easy because the offering was at 40 cents. It was a private placement. It was just too easy. So I like to save a good chunk just in case something happens. And then as the chart moves up, we talk a lot about stair stepping. As the chart moves up and as we talked about last week, as it consolidates and then moves up, I'll just add on those, consolidation marks. You don't always need to add. You can average up when you're swinging. There's nothing wrong with averaging up, as long as you're not averaging up on, a huge spike or you're getting FOMO. As long as you have a plan and you say, okay, like Trib ran to 315 on Friday, came back down to 3, and you add a little bit on the VWAP when it's consolidating to 3, it ended up closing at 307. So even if you averaged up from our original entry at 140, your cost basis is still going to be, even if you doubled your position, okay? Even if you doubled your position from 140 and you bought more at 3, that means that your cost basis is still going to be around the 210 mark. So it's okay to average up.
That is so gangster as hell, man. You are a fucking cowboy of this generation. Yeah, like you said, though, consolidation, before we get into volume, like is the meat and potatoes of this episode, we mentioned that we would talk about one stock that consolidated this week, and I think one that we both noticed starts with an S and might end with a pack.
Yeah, SPAC. SPAC is so pretty. We saw we did see a spike on Friday, but this is
SPAQ, by the way, for anyone that doesn't know.
Yes, SPAQ, and we did see some consolidation, and then we saw a move up, and we saw for the majority of Friday, we saw the continuation of consolidation. So I would really like to see it hold the area that it's at right now. I would love to see it hold this area, or at the very minimum hold like the 200-day moving average. And that would be, again, that's another buy signal. Because, again, it stair steps up, 13, spike, consolidate, add more, boom, another spike, let it consolidate, boom, spike, let it consolidate. And that's just stair stepping all the way up. Yeah. I mean, Zach kills these calls. That VTIQ, he called it in March at, what, $9? It went to $90 a share.
Oh, God.
Was that what he called it at? I think he called it, maybe even called it
I think it's like
$6.
Yeah, I thought it was somewhere in between 6 and 13, but man, that makes me sad to think about.
Yeah, he was getting so much shit for it because it didn't do anything for 2 weeks, and then all of a sudden it went on a monthly run. It carried some portfolios for the entire month, and so he just nails these. SPAC is going to be a killer, and I think that it's gearing up to be just like VTIQ, where it just stair steps and just runs for like the next 8 weeks.
Let's get rich. Okay, now. So now for the real meat and potatoes of this whole thing. It's in your hair. It's in your music. And if it's loud, it can be in your marijuana. Volume. Hugh, what exactly is volume?
Yeah, so volume is the amount of shares traded in a time period. Most of the time we're talking about volume as the amount of shares traded in a day. But if you start to look at it, you can do volume bars based on the amount of shares traded in an hour. You can do volume based on the amount of shares traded every minute. But for the most part, when we're talking about volume, we're talking about the amount of shares traded in a day. So that's what we'll use as our benchmark. If you don't take anything away from this podcast ever again, take this away. Volume is everything.
Everything to me. Everything, huh?
Everything. I don't even know where to begin because volume is so important. I know traders that purely do not even use a chart to trade, and all they use is a volume scanner, is a relative volume scanner, and no charts, just level 2 and time of sales. That's how crucial volume is. Without volume, the stock's not going to move, or, again, if too much volume, parabolic, and then again, if there's no volume to keep that price up, then we'll see it come back down. We call that a waterfall. Sorry, I swallowed my gum.
What the hell?
I know.
Vinny, keep this in, dude. Wait, can you go? We're talking about volume, but why do you do that a lot?
No, I don't. But I got so excited walking around that the gum went to the back of my throat, and I was just like,
dude, even I'm sitting down. So this is okay. What? Okay, I thought you wanted to start talking about accumulation already, but no, you were just excited and swallowed your gum. Okay,
yeah.
Let's proceed.
So, like I said, volume is everything. When we're looking at a stock, the only thing that we want to see is volume bars, consistent. So if you guys don't have volume bars on your charts, I personally use Thinkorswim, but you need to put volume charts on your platform ASAP. It needs to be there. You need to stop the podcast right now, pause it, and go put volume bars on. That is how short setups become. That's how, if you guys want to know how shorts usually find the best setups, is that they look at relative volume and they wait for the relative volume to go down to minimal. So when we're looking at volume bars, think of it like towers. You see a tall tower on the hourly, you see another tall tower, and then all of a sudden you see the volume drop. That's when shorts start to hammer the bid and start to short, because they see that the buying has the demand has dried up, and so what they do is they hammer that bid, and that's why you see these shorts that make huge amounts of money, because what they do is they hammer that bid when they start to see any kind of volume fluctuation. Now, I mentioned relative volume. That's where we'll go next.
Yeah, I think that's a really good place to go right now, because a lot of people, they don't know why 7 million's a lot on some stocks, but it's not a lot of volume on another stock. So I think that is really good transition into relative volume.
Yeah. So we get questioned a lot about literally what you just said. How do we know if 7 million shares traded in a day is a lot of volume compared to something that people say has 500,000 shares traded in a day, if that's a lot of volume? Relative volume. So relative volume is the amount of shares traded compared to the float. So something like BIOC that has over 100 million shares outstanding and has a float of over 100 million is going to take a lot more shares to move than something like Fran. Fran has 7 million shares, or BMRA has 7.8 million shares. So when we're looking at that, 1 million shares to BMRA bought is going to do a lot more to BMRA than it will to BIOC. This is called relative volume.
Yeah, dude, I think, and that's so important, because if you're not looking at the float and you're just looking at the volume on it, I mean, you're missing a good percentage of it.
Yeah, exactly. And that is why you need, like I said, you need volume bars on your platform, but then you also need to benchmark that, because again, you won't know. Who cares if it trades 1 million shares in a day if you don't know what the benchmark is? So by having average volume, you can either do it by average volume per hour if you're more of like a scalper, or you do it by day. You can do it by, intraday. So you can do something like first half of the morning versus second half of the morning. And what this is going to do is tell you, okay, this is seeing more volume and more pressure than normal. So if you're a scalper, you can use that to your advantage. Or if you're a swinger and you're getting FOMO and you can say, okay, this isn't, there's no news. This is just some accumulation. So relative volume, when you're talking about volume, is almost as important as volume itself.
I just realized Tim Sykes responded to my video of me waking up out of bed, and I have no clue what it says because he has me blocked on all my accounts. I may have to check that one out. Ooh, he might have me heated. Anyways, yeah, but what are your thoughts on tickers with volatile volume? Like sometimes they'll have 10 million in a day, and the next day they'll have 750K. How do you really handle that?
Yeah, so me being a swinger, it kind of what I'm looking for in my swings is, for instance, BMRA is a perfect example. We got in the next 2 days, we saw a huge jump in the price. And I think we're up around 30% right now. Now, the one day it had like 4 times the relative volume. The next day it had normal average volume. Now, the reason that now some people are like, oh, like, Hugh, it's down 5% on the day. What's wrong? I'm like, guys, there's nothing wrong. This is a pullback. What you want to see, a clear, beautiful pullback, is when a stock makes a high on this goes for any chart. When a stock makes a new high, dips a little bit, consolidates, and again, the key here is that what you want to see is that if you see low volume, but the price not going down, or the price staying and starting to consolidate, that is a textbook pullback. So if you guys have your charts pulled up right now, pull up BMRA for July 19th, 2020. Go back to, you can even go to the last 3 days, 1 minute chart, and look at it. You saw make new highs, you saw it come back down, and you saw the volume die off, but the price didn't go with it. That's the key here. You saw the volume die off back to average volume, and you saw the price still consolidate. That's what swingers love to see when you're looking at volume. You like to see relative volume increase, make a new high, come back down, volume die off, but the price not die off with it. Now, if you are, this can still be, see, I'm hesitant to say this because I don't want people to set up volume scanners and just start, buying everything that has double relative volume. But if you're a scalper, when you see volume go from a drastic change, that is when you can use it to your advantage, because clearly something is going on here, whether it be a fund accumulating or whether it be, your favorite guru and Tim Sykes,
Dude, earlier today, man, you were talking before we started recording with the whole SPY thing going up along with accumulation, and you touched on accumulation earlier, and you just touched on it again. Whenever the S&P is adding another stock, I thought that was a really good example.
Yeah, so we can move into accumulation, and accumulation is really important to see. I know a lot of guys who they set up long-term scanners to find accumulation. So the perfect thing that you want to see on accumulation is, and this goes back to what we were talking about low volume and relative volume, how to identify the difference. When there are hedge funds out there that one of the ways that they make their money is they wait for the SPY or the S&P to rebalance. And what they do is that when they add certain stocks, the price is going to go with it. And that's because the S&P is taking a good amount of volume, and naturally the price is going to run with it. Now, so what hedge funds do is that they'll literally just scalp it with the S&P. So what they'll do is they use because the S&P isn't just going to market buy Apple for 400,000 shares. They're going to do what's called
why not?
Yeah, I know. Why not? What they do is that they'll set it over a 5 business days, what's called a TWAP. Okay, There's no one sitting behind the computer buying 50,000 shares in a click. It's called a TWAP. What they do is that over 5 days, every half an hour, they will buy 500 shares for 5 days. So hedge funds will calculate this, and what they'll do is that they'll take a huge position on Monday and just let it ride for 3-4%, because the S&P is trying to not keep the price down, but they don't want the price to skyrocket because they're buying so much of the volume. They try and keep the average volume the same. So what the hedge funds do is that they buy a bunch on Monday, and then they figure out how long or how many days it'll take the S&P to get the shares that are needed for the S&P. So say they accumulate 1% per day and they're buying 4%. That the hedge funds know that on Thursday, it's what's called the music stops, and they want to be out, because once the S&P stops buying, the price is most certainly not going to keep going up as aggressively as it was. Now, that kind of got off topic a little bit, but the point is how we can use this in penny stocks is that if we see something, and this is why Rumble originally came on my radar, if we see something on a long-term chart that it just looks like a ski slope, and the entire thing on the 180-day chart is down like 87% on the year. Now, again, you have to have volume bars up, but if you see huge volume bars, so say the stock price went from $10 to $1, and right around at the dollar mark, you start seeing huge volume bars, but the price isn't moving much. There can be a range. This is a clear sign of accumulation. So what does accumulation mean? That's when you're gathering stock, but you don't want the price to move, because you don't want the price to move, obviously, because you don't want many people knowing that you're buying this stock. Yeah, exactly. So if you see huge volume bars, but the price isn't moving much, that's because somebody or a hedge fund, or it could even be the company, is buying huge quantities of shares, but they don't want the price to move. There's multiple reasons that they could not want people to know that the price is moving. But usually it means that they're trying to gather as many shares as possible for a good reason. It's usually not a bad reason that they're accumulating shares.
Would you consider them greedy?
Not greedy.
Jerks?
Well, I mean, like JP Morgan, nobody, like, if you hear that JP Morgan's buying 30% in, I don't know, RGLS, the second that somebody hears that, the thing's going to explode.
Well, I'd rather PJ instead of JP buy it, because that's who I trust, the guy in the tux.
Exactly. Me too. I mean, you gotta trust every guy in the tux.
Right. I mean, if I could afford one, I'd buy one too.
So the reason that you want, when I was looking at Rumble, I mean, God have mercy. I knew it was going to run. I didn't know it was going to run as hard as it did, but usually accumulation is over a certain amount of time. It's not like tomorrow somebody's going to buy 40% of RGLS and keep the price at 85. But if you see, the best way to look at it is to look on the longer term charts, where if you're new, look for charts that are beaten down and then look at the volume bars. You'll see huge volume bars, usually on the daily. That's what I would probably look at, not the weekly, because that's too hard. But if you look at the daily, you can see huge volume bars on things that are getting accumulated, usually by hedge funds. A perfect example is OTLK. For anyone swinging it with me, you'll see huge 15-cent spikes out of nowhere. And then all of a sudden the price is back down. And then you'll see huge 15-cent spikes every other day. And then the price is back down. That's a clear sign of accumulation. Someone is slapping it for like 100,000 shares, and they're not touching it. And, well, actually, I think it was more like 300,000 the other day. But like Monday, they'll slap 300,000 shares at lunch when no one's really around. And then, boom, the price is back down. Then on Wednesday, slap 300,000 shares, and then the price is back down. That is a clear sign of accumulation, because even though the intraday price is gapping up hitting 15 cents higher, the ending price is not going to do much. So again, volume dictates price.
Yeah, that's really good explanation on accumulation. And I think it transitions to Amanda Cerny on Twitter's question. Hey, C. But wants to know accumulation versus distribution.
Yeah, so this is a good question. And I think that this has to do a lot with being able to read level 2 and price action. Accumulation, like I just talked about, is when the price doesn't move much.
But the volume's coming in.
And distribution is kind of the same way, but it's different. And when I mean different is that I mean, like, instead of someone market buying 300,000 shares, they're market selling 300,000 shares. And you'll see the price pretty much come back to where it was. And now, distribution is a little bit different, and especially in this day and age, because traders are so touchy. Like the second that someone sees that, the second that someone does something like that, usually the momentum is just screwed. Even if there was no momentum, then they just create like an avalanche.
Yeah, I think a lot of the volume that comes in, even if it's just from like someone on Twitter's call, I mean, it makes the price action so unnatural where they want it to just continue as is.
Yeah, so I really think that when we're talking about distribution, it's kind of changed in the recent market because so many people get so skittish, and you have people flipping for 1 to 2 penny cents. And there's nothing wrong with that, but it's when you like load up like 20 grand and you flip it for 2 cents. That's usually, so distribution is a little different. But if we're talking about distribution and we're talking about how to exit a stock when there's news and how to know when it's kind of, getting to its peak, again, that goes right back to volume. And so if you start to see huge walls, okay, and you start to see huge walls, and you're seeing that the walls are kind of being bounced off, that this price is going up towards the walls, and then you're seeing the price pull back a little bit, and you're seeing it go at it, and it just keeps rejecting, that's usually a sign to take some off, because that usually means, because again, you guys got to remember is that there's if something's up 100%, there's probably a short waiting for it, because there's money being made on both long and short. There's nothing wrong with shorts. They have to make their money too.
In my country, not so much.
Yeah, but in reality, there is money to be made on long and short, and the shorts are seeing the same exact chart that you're seeing. So if they're seeing that $1.90 keeps getting rejected, well, 190 is close to 2. So that's a mental resistance in of itself. And then on top of that, if they have walls there, that's when shorts are seeing an opportunity. So you really want to take some off. And distribution is just when you see huge walls and, they might be moving the walls down here and there. So like I said, accumulation is much easier to see, and distribution is much more difficult, and distribution has changed in the recent market. But distribution is basically, I consider distribution to be the same as price action. If you can read price action, you'll be okay.
Okay, we have one more thing to talk about in volume if you've gone through what you need to go to, and it's just a question about it.
Yep.
Okay, it's from Lulu Jorts, and he's saying, what is delusion? And that's not like the symptom of, the mental illness, but delusion, not delusional. I actually wrote delusion, which is kind of embarrassing, and how it plays into volume.
Yeah. So first off, huge shout out to Lulu. He and I collaborate on BMRA. Awesome dude. We talk all the time. But dilution is, if anybody drinks orange juice and they don't like it very thick, when you pour that water into the orange juice cup, you're diluting the orange juice.
You don't do that, do you?
Of course I do that.
Wait. What? You don't... I'd say, how much water do you pour? You do the 80-20 risk reward thing on that too?
No. But the same analogy applies to stocks. If I am Apple and I have 30 shares outstanding and I need cash, what I will do is that I will add an additional 20 shares at a certain price. Say the price is, I have there's 30 shares and say the price is at $1. If I add 20 shares at the market, naturally the shares outstanding are going to get bigger. Or if we think about it and we're talking about a pizza slice, if that analogy does make sense. If I have a pizza and there's 8 slices to a pizza, and me and Dan were going to eat the entire, 8 slices by ourselves, 4 and 4. Actually, no, fuck it. 5 for me, 3 for Dan.
Naturally.
And Zach comes, then Zach is going to want.
Then Zach would just buy the pizza place.
No. Well, Zach's going to want his own piece of pizza, so that dilutes the amount of pieces that I have.
But you already ate your pizza, didn't you? Or you just still have the pizza?
No. This is when we're waiting for the pizza to come out.
Okay.
We're distributing the pizza.
So Zach gets here as we're cooking the pizza, and he's like, "I want pizza," and we're like, "Well, I have 3 and you have 5."
Yeah. So then I give him 1. That dilutes the amount of shares that the amount of pizza that I have. So how that plays into, so there's a few things that need to be when we're talking about dilution. If a stock does a common stock offering at the market, there's 2 things that you have to know. 1, the price. 2, the amount. Okay, and then 3, you kind of got to know why they're offering. Like Tops is just offering because it's a piece of junk. But KTOV was offering or BIOC was doing an offering so that they could, again, expand their COVID line. BIOC was doing it so they could expand the amount of testing kits that they were doing. So it's important to know those 3 things, because think about this. If the stock is at $1 and we have 100 shares outstanding, and I do an offering for 100 shares at 10 cents, 1, that now doubles the amount of shares outstanding. And I'm basically saying that I think my stock is worth 10 cents. Now, it really depends on a few things, how they're going to distribute it. The thing that I like to see is that they don't do it all at once. Because when you do it all at once, that usually means that the new common shares are going to take up most of the volume. Whereas if they do it over a certain amount of time, then it's like they kind of like sprinkle it in. And sprinkling it in doesn't affect the price too much. So that's just something to be aware of. If they're going to do an offering, like UAVS did an offering, okay? What you want to know is, 1, you want to know how much. Like, does this really feel like a company that has a 10 million market cap, should they really be doing a $5 million offering? Chances are not. And if it's going to the CEO, I'm going to be pissed McGee about it. But if it's for ongoing orders and to expand something to add shareholder value, then I'm okay with it. And if they do it at a decent price and they're not like doubling the float, like if you see something that doubles anything above 20% of the float, be done with it. Be done with it. There's no point in it, because if they're increasing the float by more than 20%, then just be done with it. Zom, perfect example. Just be done with it, okay? Because they're being greedy. They know what the share price is going to do when they add a common stock offering of 20, 25% of the float. They know exactly what they're going to do. That's terrible management.
Okay, so that sums up volume, and Hugh is a little pissed. He may need a break. Drink some water, buddy.
I am. I am. Bad management, gets me going.
Dude, okay, so our last 3 segments are going to be Q&A. Hugh has some DD to give us, and then we got a scenario of a guy with $17K in his savings, and he wants to start trading. So you ready to get into some Q&A?
Yeah, let's hit it.
Okay, what are some sell signs to look for after a stock shoots up? I know you may have got into this in volume a little bit, but...
Yeah, so there's a few things to look at. And I like to, I always use this analogy because that's how I trade, but you don't have to trade like me. I like to trade, and a lot of people say, oh, okay, well, green is green, so even though I missed 50%, green is green. And that's true. But if you're making 10% when it ran 100%, then maybe it's time to reevaluate.
Hugh, I'm trying to fucking feed myself.
No, you're a different story. You have your strategy. But I have a lot of guys that come into my DMs and they say, and women, we're not sexist here, no sir, or man, no ma'am or sir.
Hey, and also, if they're non-binary, I would accept their DM too. So
exactly.
I mean, that is just me and Hugh. I mean, no one feel afraid to DM us, especially if you're a woman. Like literally, if you're a woman, you have a lot higher chance of me responding. Anyways, where were we?
Yeah, so I have a lot of DMs that come in and they say, hey, man, great call. I made 5% on that some bitch. I'm like, excuse me? And they're like, oh, yeah, dude. Like, the schmucks that strive for 4% a year, yeah, you kicked their ass. And I'm like, dude, that thing went 100%. And he's like, oh, yeah, but I didn't want to get greedy.
It's got a point.
Yeah, and I was like, dude, but like, if I'm going to hold something, and this is something else that everyone needs to understand, is opportunity cost. If I'm going to hold something for over 2 to 3 weeks, I'm damn sure going to get more than 10%, because if not, I can just scalp anything. I can scalp anything for 4%. But the reason that I do this is because I see greater risk to reward, and I see less risk, greater reward when I do swing things for 2 to 3 weeks.
No problems, baby. You're living relaxed.
Exactly. Easy peasy. So it's important, and this is kind of my squaring it back in. My thing is that I would rather get off 1 bus stop too late than get off 10 bus stops too early. And what's that mean when we're talking about stocks? That means that, okay, if I say the stock hits, say we get in at 40 cents and the stock hits 120, and I end up getting out at 111. My motto is that I'd rather get out at 111 and miss the top than get out at 60 cents and miss that huge run. And that's just how I trade. Doesn't mean that everyone else has to trade like that. That's just how I trade. So some things to look for when you think the stock is about to be done. 1, walls. Level 2, I can't explain price action. You just have to be able to read price action. And part of that has to do with level 2, has to do with time of sales. It has to do with earlier resistance points, has to do with mentality. So if we're approaching $1 and $1 has been the double top, well, guess what? This is going to be one of the toughest resistance. But if we get through that resistance, then we're skies clear.
Yeah, dude. Your analogies have been fucking spot on, by the way.
Oh, stop it.
No, the pizza, the whatever the hell this one was.
Bus stop.
Yeah, the bus stop. Yeah, you're saying about the walls, but I mean, with PJ and Zach, with the magical calls, the only walls we're worried about are the vaginal walls.
Oh my god.
Huh?
Yeah, funny guy.
Thank you.
Yeah. So again, if you got to be able to read price action, and this comes with staring in front of the screen for a certain amount of time. You're not going to learn price action overnight, but
it really does come from just looking at the screen a long amount of time, for real.
People are like, oh, well, teach me price action.
8 hours a day, buddy.
Yeah, you got to watch level 2. You got to watch time of sales. You got to know the chart. We talked about this in the stream. You have to know the personality of the stock. So a lot of people, when BIOC didn't run, we got into like 35 cents. It ran to 70. And people were like, dude, like you told me it was going to $1. And I was like, yeah, like, can you relax? Like, watch out. Like, if you knew the chart, you would know that 60 to 70 cents is huge resistance points. So you would take some off and then buy more back when it dipped until we got the PR that eventually sent it over $1. So I think knowing the personality of the stock, being able to read price action, which that includes knowing the resistance points, knowing time of sales, how to read time of sales, and just seeing, okay, what's coming through the tape? Are large sell orders coming through the tape or large buy orders? And then of course, being able to read level 2. And that's my best answer to how to know how to get out of a stock is price action, price action, price action.
Perfect. Okay, yeah, dude, we didn't talk about personality of the stock. I think we should do that next week for sure, because you on the stream, you did a really good job talking about that, and I feel like that clicked for a lot of people. We have 2 more questions. One you answered on Twitter, but I feel like on here you may be able to voice it a little better. Give us a quick little recap of your 80-20 risk reward, or 20-80.
I'm going to clear my throat here because
he's going to get pissed again.
No, I'm not going to get pissed. I never get pissed because I understand. I just think that it's don't overthink it. If you've seen me on Twitter talk about this, okay, do not overthink it, okay? I literally cannot use your or their correctly in a sentence, okay? So if I can make this, so can you, all right? Now, this is what I'm going to say, and I'll say it a few times. Before I take a position in a stock, I want to make sure that there is an 80% chance that I will get 100% or more gains. Okay?
Gotcha. Yep.
There is an 80% chance that I will get 100% or more gains. Okay. And my risk is there is a risk of 20% of not getting the 100%. 100%.
Okay, cool. Yeah, got it.
Yeah, so to be clear, this isn't a take profits at 80% and stop loss at 20%. This is an 80% chance that I will get 100% gains. Okay? So I'm not taking a position in a stock unless unless the chances of me getting 100% return are
4 out of every 5 chances. Yeah, I mean, it makes sense. I think I just didn't want people setting a 20% selling, you know.
No.
Yeah.
No. You know, right. I was wondering why my shit kept selling off at 80%.
Like, dude, everything's messing up. Okay, so last question. How do you feel about upcoming ER Quota 2?
Yeah, so one of the huge things that we need to talk about is, and we talk about this a lot, is that in this day and age, okay, the day is July, we're midway through July 2020, everything is overextended. Literally everything. Okay, I just did a report on Nike. Nike is literally the only stock. Just did a report for my management 490 class. Shout out Professor Nevis, whatever his name is. Nike is literally Nike's literally the only stock that I can find that doesn't have a PE, so that's price to earnings, of like 5 times what it's supposed to be. So what does that mean? Price to earnings is the future expected value that people are willing to pay. So if we're thinking about Amazon's expected value, so that's how much they make, so that's price to earnings. Right now, their stock is trading at 137 times their PE, what their price to earnings is. So to put that into perspective, the average that it's been in the last 75 years, and that's the S&P 500, and that's kind of like the benchmark that everyone uses, is 10 to 15%. A growth stock, so that means something that is innovating, it usually trades around the 18 to 20 mark. Amazon is literally 10 times that.
It's absurd, man. Yeah,
it's absurd. And that's just one example, but everything is trading at huge PE ratios.
In other words, be careful as heck.
Yes. So we saw on Netflix didn't have terrible earnings. I mean, Netflix had decent earnings in comparison.
A lot of people said, like, this is the highest you could ever get for Netflix. Everyone's home, like, they'd get the most usage and everything. Like, how can it ever get higher?
Yeah, exactly. And the thing is that it didn't matter what Netflix's earnings were. It didn't matter if every single person in the United States had Netflix and streamed Netflix 24/7 a day.
That'd be a productive country.
Yeah, yeah. Okay, it doesn't matter. It's the fact that Netflix was already so overpriced and so overextended that I wouldn't be surprised that, again, don't come in my DMs and you said that everything was extended, and then Black & Decker killed expectations because everyone's doing home approvals and I went short on it. Okay, don't do that. Don't short everything that has earnings. But
not financial advisors, by the way.
yeah, not yet. Not I'm
the opposite.
In a sentence.
I'm the opposite of a financial advisor.
Yeah. I can't spell. He
can't speak, apparently.
Yeah, I can't speak. So do not take my advice, but understand that everything is so overextended right now, and I would not be surprised that even things that have great earnings sell off, or at the very minimum, if you're going to do like I know some of my friends do, weekly call options for earnings or weekly puts, again, do not, if not a sell-off or, a dip, expect that even with great earnings that it'll just sit there, basically.
Okay, so perfect. That sums up the Q&A. So the DD King, the DD Prodigy, skipping biology class in middle school to read SEC filings. Tell us what DD you're gonna tell us about the wheres, the whys, the hows. Just try and maybe give us a good 5-6 minutes on how you did your DD for whatever stock about you. Tell us.
Yeah, so we can do. Let's see. I don't know, Dan. Which one would you like?
Oh wow. Do you want to do one that's already gone up, or do you want to do one that you've done it most recently on? That'd probably be the easiest for you.
Yeah, we can do that.
Because didn't ONTX maybe?
ONTX, yeah. So I think that's Bog, and that is Zach swing. But I still did do extensive research on it. And this is a credit to Bob. Bog Trading especially, because he did most of the legwork here, and Zach as well. ONTX is going to report their Phase 3 readout this week. And what does that mean? Phase 3 is the very last phase in the FDA that the FDA considers trials. So you have preclinical, so that's kind of easy. That's, as long as you're not poisoning people, you should be all right, I guess. Phase 1 is with a very small specific group. Sometimes it's not even on a group. Sometimes it's on animals. I mean, there's a lot of different things. Then you have Phase 2, which is a little bit bigger. That's if most of them don't make it through Phase 2. But if you do, a majority don't make it through Phase 2. But then if you make it to Phase 2, then you go to Phase 3. Phase 3 is the final phase. And this usually takes a much longer time, and it is usually your last step before going to market. Okay, so ONTX reads out on Tuesday, and it is expected to be good. Now, if it is good, that means that within the next year, they can go to market. There's a lot of different things floating around about what the market cap could be, what the market should be, et cetera, et cetera. But one thing that we've seen is that we haven't seen, usually when there's a huge Phase 3 like this, is that we usually see not a short report, but kind of hey, this could happen. So that's really important when we're talking about Phase 3 trials. And the other thing is that ONTX, this could substantially, I think I was reading that this could do 4 to 5 times their current revenue. So wow. Yeah, exactly. So this is a huge deal for them. And with us not seeing, one thing that's huge is that there is no delay. The other thing that's big is that we haven't seen a delay. We haven't seen any huge short reports on it. And so, again, I'm not a scientist. I don't, it's basically what
You're not a scientist?
I know. Shocker. I'm barely getting through my bachelor's.
Bio Hugh.
Yeah, exactly. But one thing that is really, really awesome is that we aren't seeing any short reports on it, or, again, I don't want to call them short reports, but just reports that are cautioning against the Phase 3, which is really good. So if the readout goes as good as it is expected, you can see this thing. You would, yeah, I don't even, the $5 price target is not, because again, you still have to bring it to market. Okay. You still have to bring it to market. and that usually takes about 8 months. But nobody wants to buy a stock until they know that the phase 3 is done. So once the phase 3 is successful, then that's when you see a huge, I mean, this thing, you'll see a rocket on the day that it's approved, and then you'll probably see a run for the next good while.
How many rocket emojis are you going to use?
Oh, dude, I'm not a big rocket guy, but now, So again, this is Bog's play. If you guys want to see more DD, it's all on Bog's page. I think Zach's on it too, right? Zach's on it.
Yep.
Yeah, Zach's on it as well. And like I said, is that, again, phase 3, again, you got to be cautious. But from everything that we know, it sounds like Bog could have like a supernova on his hands. And then that's when you really look at, if they say that the revenue will increase 2 to 3-fold, then that means that the market cap usually will increase 2 to 3-fold. And then on top of that, you start to get partnerships and you start to get sales teams that literally third-party sales teams will come to you and say, hey, we'll do your sales, but we want royalties or we want a piece of the pie, et cetera, et cetera. And then those sales teams, literally, now that they have a piece of the pie, is that they want to go and sell it. So they'll have like 60-person sales teams. So my point is that phase 3s, you usually have to be careful with them. And there's little things that you can look for, like, if you start emailing IR and the IR is like, oh, like we'll do it when we want to, blah, blah, blah. Or, you start to see that like, things are really starting to slow down and you're not seeing much from management, or a delay is horrible. You don't want a delay. Or, certain things like if you see an offering right before, that's not good. So there's really things that you can look out for. And so far, ONTX has passed all the check marks, and we're getting into the week that they report. So if approved, I wouldn't say that over 3 isn't possible, especially if it's as successful as it's supposed to.
Okay, dude. Hell yeah. I'm glad I have a good amount. Okay. Well, following that is our very last segment. Next week, you can do DD on something that you did that you can go in a little more in depth, but volume was quite a long segment. 17K. So this one's from a guy named John in the DMs. He said, hey man, quick question because I'm young like you. I've got 17K in my savings. This is a lot for me, but I want true financial freedom and to set myself up for the future. I know you're not a financial advisor, but what would your mindset be to take advantage of this market while I'm young with the bulk of my savings? Or start with a small investment and just try to build it from there. I appreciate you, brother. I don't have any expenses if that helps, and paying my bills isn't an issue. So with that, I sent him back. I said I'd put 2K in and give it a shot. After you feel profitable, put more in. Don't get I'm losing because I don't have the 25K mentality, and just play with what you have. And whenever you start seeing it work, put more in. 3K maybe.
Yeah. I mean, for everyone that follows me, they know that I'm doing that fun account. And that fun account, like I said, even though I'm starting over PDT, I'm trying to do it in as little amount of
trades as possible. Yeah.
Exactly. Yeah, the smallest amount of trades as possible, and from 30,000 to $1 million, and that's what I'm doing. So it's purely swings. And so even though I'm not doing it under PDT, the same rule applies. I could go forever without doing PDT, but I think the biggest thing, like you said, is to take a chunk. Now, I'm always more Cal. If you're young, you have a little bit more discretionary expenses. Like I said, I blew my net worth, and honestly, it was the best thing that ever happened to me because my net worth at that time was, peanuts compared to. But
compared to what, Hugh?
Yeah, I know. But really the best thing, and we talked about it last week, was to take a small chunk and find a strategy that works for you. Master that strategy. Until you have huge percentage gains on that strategy, don't even touch anything else. Just don't. It doesn't make sense. And then once you feel confident, that's when you start to scale up. So start with like 3, maybe 5K, depending how, how ballsy you are, quote unquote, and prove to yourself. Now you're not going 5K in each thing. It all depends on the strategy that you're going to create based on someone that you follow or, based on whatever strategy you decide. Master that strategy, and then go from 5K, and then once you get up to 10K, then you can start to make your starters bigger and start to do something like that. And then as your account grows, just naturally grow your starters and everything that you do. So if your account goes up by 20%, grow your starter by 20%. And then that's how, a lot of people get queasy in the stomach when you get over the 100K mark and you're realizing that your starters have to be much larger. Don't do it all at once. Don't go from having a starter at 10,000 to going to have a starter at $1 million, because that's just going to make you throw up every cent that goes down, if it does go down. So, again, to reiterate, take a small chunk, grow naturally, find a strategy, master that strategy, and then as your account grows, grow your starter. And then that's how you can naturally, kind of like a stock, stair-step growth your account.
Yep, I've been growing my starters just because I've been scaling out the same, but I've been, growing my starters. So I would, by the time it gets to where I'm usually out, if it runs anymore, I can handle that. I can handle the extra gains.
Exactly.
So I think that sums up the episode. If you made it to the end, make sure to comment on Twitter your favorite brand of water, because we're really looking for the real ones here. Mine's Dasani, and I also like Sam's Purified Bad Boy Life. Yeah, thank you for tuning in. Hugh, any last words?
I only drink tap. I'm too cheap for Dasani.
That's hardcore, dude. All right, we'll see y'all next week.
All right, bro.
See ya.